Good evening, Professor Valentine. Today I will be discussing the uh, Module 8, Assignment 1, which basically is the difference between money markets and capital markets, and how for-profit organizations use these resources to fund business growth. So without further ado, here we go. Before we can figure this out, we first must understand what a financial institution as well as a financial marketplace are, and then we can move forward from there. So basically, a financial institution is a company engaged in the business of dealing with financial and monetary transactions. The examples of these are deposits, loans, investments, currency exchanges, things like that. And then your financial marketplaces refer to pretty much any market where the trading of securities occurs. If you don't know a security, obviously you know, but if for a security would be like a bond or a stock, something like that. So stock market is a financial marketplace example. Yeah, also financial institutions, they'll vary in size. They can also be considered financial intermediaries as well. So that's according to the textbook. So now that we got that out of the way, we can look at the different types of finances. For this assignment, we have the short term and the long term. The short term is typically 3 to 5 years. Some are 1 year, but the typical is 3 to 5 years. It has a floating rate. It is financed and supplied by a bank. And then they're used for working capital. And then their source is bank loans. Again, so yeah, and then long-term financing is typically 5+ years, even up to 25. They work at a fixed rate, and they're financed by investors, and they're used for expansion slash growth, capital, and debt diversification. That is according to the article, The Benefits of Long-Term versus Short-Term Financing, that I have linked below. And so their source is foreign investment. And yeah, so now we can move on to the money market. The money market is a market for short-term lending systems with maturities of 1 year or less, such as treasury bills. That's an example that I found on the e-text. And lenders will use it for extra cash. So they'll use the money market in that way, or they'll use their extra cash within the money market to generate. And so the money market is typically less risky versus capital, which is long-term. And so it's typically things like stock. It'll raise money over time. It has a primary and secondary market and securities within that. So the primary market of a capital market is securities that have never been used, and then secondary are ones that are used and resold. There's more risk, higher reward though in the capital market, whereas the money market is obviously lower risk. And so really quickly, just some real world examples of a capital market. You can look at the New York Stock Exchange. For your money market, you can look at repurchasing agreements. For your short-term financing, you can look at a line of credit as a real-world example. And then for long-term, you can look at bank loans on an investment or on a property, or there's millions of other examples. And pretty much, yeah, that's everything.